Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
You know, the market's got a little dicey here in the last 5-6 weeks here. People starting to build up a little bit of a wall of worry as it relates to that higher for longer type thing. And then, if that's not enough, then you got a government that might be on the verge of dysfunction. You don't have a speaker and all that kind of stuff.
On the verge of?
Yeah,
I mean,
right.
We have a dysfunctional government.
We have a dysfunctional. Yeah. Let's just go there. Let's see how the pros are kind of putting it all together. Phil Toews joins us, CEO of Toews Asset Management. Phil, I mean, how do you put this situation that we've got down in Washington with the House of Representatives, how does that kind of weave into your investment outlook here?
Well, we've already gone defensive over the last 3 weeks. We've moved into a fully defensive posture.
What does that mean?
Well, you may remember that we actually can move fully out of equities onto the sidelines in T-bills. So that for 85% of our roughly $1 billion is in T-bills. Wow. But what's not, a lot of it has full notional value of put hedging. So that means defensive, not just like defensive stocks.
Yep.
But here's what I find so interesting is that, you know, if you look at what happened with the debt ceiling negotiations and then the recent budget impasse, is that the market has tended to just ignore it, right? So we were shocked at the debt ceiling negotiations that markets weren't freaking out. We were, but the markets weren't. And I here's the way I think it looks. I think that, you know, again, it's sort of I was expecting, disarray in the House. Markets are going to open very negative this morning. Obviously, that didn't happen. And I think the way this looks in terms of government dysfunction is that we have more that same thing until and if we reach a point where the dysfunction really is full on and plays into the fact that, we're just going to have the government be closed for, maybe 10 days, maybe 35 days like we've had in the last 20 years, or maybe longer. And then I think potentially you'll have some real market movement, just as we did when, they were trying to negotiate the debt ceiling under Obama, and the leaders agreed to something, and all of a sudden the legislature said, no, we're not going to do that. So I think, the market's just going to be sanguine about this until it's obvious that things are just so broken that it's going to be a very bad scene for markets.
So let's talk about holding treasuries here. Yeah. How painful is it if, the 2-year goes from 5.11 to 5.20 or 5.30? Like if these rates keep on rising, and I will admit, I didn't think they could go any higher last week or maybe even 2 weeks ago, but it seems like they continue to do that. Not today, but, how rough is it if you're holding 2 years and they move up 20 basis points?
Yeah, so I think we need zero duration, basically, as close to zero as you can get. So across our platform, we're just in 1 to 3 months, right? So you really want to be on the very, very short end of the curve. There's no, the worst trade ever. I was talking to a massively big advisor about 2 months ago, and he said, I think it's time to go really long duration. And I said, maybe you should wait on that. Well, that was a really bad trade. So you need to be in T-bills at this moment, because the breakout is really the most important thing that's happened, obviously, over the last 30 days. And, I think it's just the fact that you have this relentless advance in yields that keeps bringing the markets lower. Now, we have a little bit of a reprieve today on the 10-year. Thank goodness for that. But there's, if we could be at 5%, I think it'll be interesting to see, though, if we reach 5 and then we pause. I mean, if we can just stop increasing and stop the breakout, it'll be interesting to see if markets can sort of regain their stability here. But as long as we're moving higher, no, not 2 years, not 5 years, not 10 years, good heavens, not like 20 years. Bring it into 1 to 3 months, in our opinion.
Although TLT has seen massive inflows, right? That's a ETF with 20 years plus. Like, everyone's been going out the curve. Everyone's been buying these long duration bonds as we get higher and higher on the yield. And you expect, like, if you buy the 30-year right now, you're getting 4.9%. So, as long as you're holding it to maturity, that seems like a good trade, right? but
yeah, right. So like hold that 30-year to maturity. That would be a great plan.
Well,
look.
I wonder. I mean, if it turns around now, if this is the peak, but what do you think the peak is?
I just don't know. But I don't think you got the acronym BFF. I don't think you want the long bond to be your. I think you want the short term, very short term, to be your BFT, which is your best friend temporarily, right? And you just can't work against a trend like we see happening right now. Look at the stock market for the last 3 years. Inexplicable. All of the moves have been inexplicable. Like the advance this year, the advance during the pandemic. So it's just not possible to call the market. So why would you make that trade? Why would you make that trade until a trend comes along where you've got an opportunity? And look, so in terms of the long bond, what we're salivating at the possibility about, because we're defensive now and we're in T-bills. But if the trend changes and all of a sudden things fall off a cliff in terms of stock market, things look very bad, and you actually see a change in direction of yields, that's an amazing opportunity in not just long bonds, but in just even conventional bonds like aggregate bonds. So we're waiting for that, but it's not right now, and I don't think you make the trade at this moment.
Do you have to wait for the Fed actually to signal rate cuts are coming?
No, I think what you do is you watch the trend of yields, and you watch the trend of just the price of these bonds. That's what we do. So we just really ignore everything else. And so that, typically what you see is the market, the bond market will, about a month before you see any Fed movement or you hit actual peak rates, you start to see a change in direction of those bonds. So watch the price of these bonds more than anything else.
So in terms of, I guess you got to wait until you see the whites of its eyes, right? That's been the same thing with any government shutdowns. If you think that's going to be horrible for markets, well, it doesn't seem to be until things go overboard. Do you feel the same way about the broader, government debt picture? Because right now, 33 trillion and counting. We know entitlements won't be funded for probably more than another decade. Does that not matter to markets until we get to, past the deadline?
Yeah, so that's the most important thing that we think is going on in the markets. I'm here in Austin, Texas, getting ready to fly out back to New York. And yesterday I spoke again at a broker-dealer conference, and I talked about the hidden implications of global debt. So you've got this situation where the lender of last resort, right, always saves the day. And so over and over again, we go through these market crises, and then the Fed comes in. Well, we all know the Fed over the short term isn't going to come in and save the markets. But I think what you have to ask the question about is if you actually tip into a recession, if it's a hard landing, then you've got the potential for decreased GDP at a time when debt to GDP is already high, the possibility for increased need for fiscal stimulus, which gets you to the point where all of a sudden this all maybe looks unsustainable. And so the giant wave that we're ignoring right now that could be upon us at some point is the fact that, just as we saw in the UK last year, that was the most I think, poignant data point to look at when treasuries collapsed last year, when all they did, guys, was they passed a bill that decreased taxes and increased spending. So who cares about that, right? Normally in the US, but if you ever have a situation where you've got to start to have soft auctions for treasuries. Now, I know it sounds like conspiracy, crazy stuff, but really it's just you're kind of not there, and then you all of a sudden are. But if you get to the point where instead of 100% of GDP, you're 110, 120, 130, that's the big question. Is what do you do with this lender of last resort all of a sudden not being an effective tool anymore? That no one really talks about that. No one thinks about that. But if you look out 5 or 10 years from now, I think we'll look back and say, wow, what were we thinking of? We were worried, this dwarfs the mortgage crisis, dwarfs it.
On that note.
Okay, there you go.
On that note, we're going to leave you right there. Phil Toews, thanks so much for joining us as always. Phil Toews, CEO of Toews Asset Management. 85% of their portfolio in
T-bills.
T-bills, not even T like notes or T-bonds, T-bills. So ultimate short term there. That is a cautious portfolio. That's almost like a doomsday portfolio, but I appreciate getting his thoughts as well.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Jamie Patton joins us. She's from TCW. They know what they're doing over there when it comes to the markets. Jamie, the last time we talked, we were talking about, or maybe the discussion in the marketplace was soft landing, hard landing, no landing. But boy, you took it another step forward with your aviation knowledge. Where are we now, do you think, as we kind of feel a little bit more comfortable with higher for longer, I guess?
Our views are unchanged. So we understand how the markets have been willing to give into this no landing view. And just as a reminder, I think it's a really terrible analogy because it defies the laws of physics. Airplanes run out of gas. I'll keep saying that until people stop using the analogy. But this kind of things are different this time. It speaks to the underlying optimism that higher rates will simply just be absorbed without any effort. Things are different. The economy is no longer leveraged, just no longer rate sensitive. And at TCW, we completely disagree with that. We understand that it's exasperating to wait for the proverbial shoe to drop. Market participants are tired. They're impatient. It's been almost 19 months since the Fed's first rate hike. Nothing has gone awry yet, but we still think it's early. It's only not even 19 months from the Fed's first rate hike. And of the prior 13 hiking cycles, only one has turned into recession less than 19 months after the start of a hiking cycle. So a recession today would still be early. We're still relatively early in the cycle. Even though we're approaching the end of the Fed hiking cycle, we're still relatively early in the economic cycle. And we talked about it last time, but we still have the view that lags between the Fed's interest rate hikes and the impact to the economy are longer now for many reasons. So while 19 months is early historically, we think it's even earlier from the perspective of lags are longer.
Yeah, Jamie, with all that in mind, where are you guys putting money to work then, just given if you're kind of taking that point of view that it's still early in the cycle?
So at TCW, we really like duration longs. We've been adding to them. We don't claim to know exactly when the top or the bottom of the yield range is going to hit. So we dollar cost average in, and we liked them the last time we talked. We like them even more now. So we've been adding to our long positions. We also think that the curve will be steeper. Monetary policy will continue to be the big driver for rates in the economy, especially at this point towards the end of the Fed hike cycle. The Fed is likely to over-tighten. That gives us even more confidence in our long duration positions. If you want to keep going with the flying analogies, I can give you one comparing the economy today, and it gives us more confidence in our long duration position. But the National Transportation Safety Board always writes these crash reports after every airplane flying accident. And as a side note, and I promise I'll connect this to the markets in a second, but fascinating. They read like a novel. So JFK Jr.'s infamous flight crash into the Atlantic Ocean, the NTSB report starts 20 years prior to the crash. It talks about when he got his license, he had a broken ankle from a hang gliding accident, why he left for the airport late, the traffic he got stuck in, he didn't get a weather briefing. The point is that these accidents aren't caused by just one thing. And it's a confluence of everything combined. One thing you can recover from. So when we look at the markets today, it's beginning to read just like a crash report. If you were going to write an NTSB crash report about today's economy, it would probably start back in the 1970s when Arthur Burns reversed course on rate hikes too early. That resulted in this conventional wisdom that cast Burns as not wise or strong enough to keep rates as high as they needed to be. Then Volcker is glorified for having the courage to relentlessly keep rate hikes. And then you have Powell, 4 decades later, carrying around the Volcker memoirs, talking about how that's a great lesson. It should be required reading. Combine that with a global pandemic, fiscal policies, arguably helicopter money, a surging deficit, increased treasury supply. So now you have global central banks raising rates in the front end in uniform almost across the whole world. Meanwhile, you have longer rates going higher for all the aforementioned reasons. All of a sudden you're like, don't forget about, a leadership vacuum in the House raising the odds of a government shutdown. So you can kind of see how these things are all coming together and creating a really hazardous environment for financial markets and the economy.
Jamie, you mentioned a potential government shutdown. It seems like the chatter is back about a potential downgrade on the back of that, given right now it seems like all signs indicate a shutdown in mid-November. How are you positioning that, and what are you thinking about in terms of a potential government shutdown, and what would happen if we were to see the U.S. get downgraded?
We think that's a very high possibility. We expect the government is much more likely to shut down now than it was before yesterday's events. And Moody's already came out on Monday and said, they're considering, it seems like it's more likely that they'll downgrade. U.S. Treasuries are a little bit strange in this aspect where yields tend to go lower, not higher, when the Treasury gets downgraded. So it's the opposite of a more of a credit risk asset, where it's a flight to quality. In terms of the economic impact, we don't think that we'll see a contraction with that quarter's GDP growth, but typically we get that back the following quarter. So we don't see it as big of an economic impact as we do just more uncertainty, more spending, more markets just don't like this kind of like lack of organization, lack of structure, lack of getting anything done, more spending. So on the margin, we think it's bad for risk, but from our long duration position perspective, we actually think on the margin it would be a positive for that.
So do you expect the Fed next year to cut rates? And if so, when?
We do. The Fed's own forecast only has them cutting rates maybe 2 times next year. That's assuming this perfect, soft, immaculate disinflation landing. And that's not necessarily our view. We think that they're going to have to cut harder and more than expected, but the timing is relatively uncertain. Maybe at some point in the second half of 2024, when we see this sort of financial accident or a bigger hit to growth, a bigger hit to risk assets, because it comes in the form of more of a bigger accident, a bigger slowdown in growth. It's harder to predict the exact timing. But we do think, even just if you take out everything else, just the fact that we have such flatter inverted curves, that in and of itself is a negative impact for investment, consumption, and employment, which just by itself can lead to this negative self-reinforcing downturn. So they're kind of all these aspects that are combining together, and we don't claim to predict the future, but we see all these reasons why the economy could take a turn, and yet another reason we like buying duration and being long bonds in this environment.
I'm looking at swaps right now. The odds are slowly dropping about another hike. Do you think we could get another hike this year?
Our base case is probably we don't need it. Probably not, but we still think it's 50-50. The Fed told us that they're data dependent. The data between now and the end of the year could shift on the margin towards one more hike. The Fed's own forecast is that they have one more hike. So we could definitely see it, although it's not our base case.
Jamie, you're a pilot in the Los Angeles area?
Yes.
How do you find airspace and not get run over by these jumbo jets coming into LAX?
You stay away from the LAX airspace. There's actually a corridor through LAX that you can fly, just visual flight rules as a private pilot, and you're kind of guaranteed to avoid all that. But yeah, it's pretty busy. And I would just also like to say, while we're talking about my personal life, that all of this, Jamie knows all about hard landings because she's a pilot. It hasn't been great for my pilot brand. So I want to emphasize that I know about this from reading things like NTSB crash reports, and my own pilot record is perfect. So just to put that out there.
Excellent. No, I know. I know you've got this. You've got this hobby. You like to read these accident reports, but that's a great way to learn what not to do, I guess.
Yeah, in financial markets as well.
Very good, Jamie. Always great to talk with you. A lot of interesting stuff. A lot of fun along the way as well. And good luck with your flight career.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm looking at the Bloomberg Index browser. Go.
Whoa, I was just looking at that too.
Wow, great minds think alike. The only thing I'm looking at the bond market here, the indexes, sorry. And
indexes is official Bloomberg style.
I understand. And the only one that's positive for the year is the high yield corporate
high yield
index. So,
I was looking and I saw U.S. treasuries in general, right?
Yep.
That index is down 4.7% this year. And remember, it was down 17.5% last year. And the year before that, it was down 6.5%.
Yeah.
So if you're long treasuries into the pandemic, you got thwacking.
Thwacking, that is a CFA level term. Let's see what the quants are doing out there about these markets here. Huw Roberts joins us, head of analytics at Quant Insight. Huw, what are your models telling you about these markets here? We had a huge move up in yield. The call seems to be higher for longer. That's making the stocks kind of problematic out there. What are your models saying?
Yeah, so I agree with the thwacking comment, basically. All our macro fundamentals, which can be distilled into three broad buckets: economic fundamentals, measures of financial conditions, measures of risk appetite, are doing a very good job of explaining most things at the moment across bonds, currencies, and equities. And the primary trend, the kind of momentum of our models, remains unchecked. So even though there's some kind of anecdotal stuff around in the last couple of days that maybe we're reaching a bit of a capitulation phase, if we look at our model value for treasury yields, still pointing higher. If we look at our model for, say, dollar yen, even though there's intervention risk around, still points to higher. If we look at our model for NASDAQ, it's had an amazing it's fallen 20% in the last month, courtesy of actually what you guys were just talking about, a mixture of rate vol, which we use as a measure of QT, QE expectations, and the move in credit spreads that you guys just alluded to. So the basic message is that the tightening of financial conditions that has been engineered since that last Fed meeting is just having a rolling effect. And for the time being, at least from a pure macro modeling perspective, we don't see any change, I'm afraid.
So my takeaway from all that is you see yields going higher from here? I mean, how much higher?
Well, so what we do is because we're modeling all these things in real time, we're kind of capturing macro momentum. So there's two key outputs that we produce. One is where do macro conditions say things should be right now, whether it's SPOOs, 10-year yields, dollar yen, whatever. And then secondly, we then compare that to where things are trading. So you can kind of see if there's a valuation gap, because obviously some asset classes lead, sometimes they lag. There's these gaps that create short-term tactical trading opportunities. So right now, we have 10-year yields. The model value is pointing higher, has been for several months, but is accelerating. But the good news, or the compensation news, is that the market is simply keeping track with the move in macro warranted fair value. So there is no valuation gap of note. They're kind of sitting on top of each other. 10-year yields are where they should be given the prevailing macro environment.
Huw, when I look at this, when I look at the government, when I look at the strikes, even when I look at basically consensus for a soft landing, I feel like this economy is going to crater. Don't you want to hold treasuries, even longer duration treasuries, if that's the case, if we go into a deep recession?
Yeah, I get that argument, but I guess that's why the bulls have been loaded up on duration since the start of the year. Now, I know there's different surveys telling you different things, but, the Commitment of Traders report will tell you that asset managers have been long for that kind of recession call for the last 9 months plus. The same report says hedge funds are short, but we know a big part of that is polluted by basis trades. Now, I know there are other surveys that will point the other way, so you can pick and choose your data on that. I guess the better answer to your question is it's not obvious at this juncture that actually treasuries are trading as a growth dynamic. It's not obvious that they're going to give you that recession hedge, that actually what they're trading off is the sense that rates are going to be higher for longer, that, we're kind of removing the 2009 period on and the new normals reverting to the old pre-GFC normal, that treasuries are focused on budget deficits. They're focused on shenanigans in Washington in terms of the ability of politicians to stay on top of this stuff. And they're focused on the fact that deficits with the supply needs that implies is buffering up against QT rather than QE from the Fed, foreign central banks stepping back from buying, and just the normal sponsors of bond yields at these points, they can afford to step back and wait for better entry levels. So at some point, what you say, I think, will be spot on. I'm just not sure that this is that point.
Huw, you said we're probably not there on capitulation. What do you look for as signs of potentially capitulation? Which markets do you look at? What should we be looking for?
Yeah, all markets. I think when you get to the kind of environment we're seeing at the moment, then the old adage about something's going to break is very true. So you can then draw up a list of potential candidates. Probably top of a lot of people's list will be commercial real estate. So you can draw up a watch list of kind of ETFs like the REIT ETF, or individual names like the Vornados or the Boston Properties, and use those as your canaries in the coal mine. If CRE is going to go, what does that say about balance sheet? So let's keep KBRE, KRE in Europe, the SX7E future. Keep that on your radar. There's some kind of nice proxies I like to watch for private equity, because there's a lot of theories that 10 plus years of easy money have encouraged private equity to lever up, and that might be one potential swimmer who's left naked, to use the Buffett speak. There's something called business development companies, and BDIS is the ETF that you can track to follow those as a loose proxy for that side. There's lots you can watch. And I think that the main point that this is a very subjective, this is not the quant side of QI speaking at all, it's just me, but I would say for the last month plus, what we've seen has been pretty orderly. It's actually only been this week we're starting to see the first signs of capitulation. And I would cite Monday's price action in utilities. That smacked of capitulation to my mind. Dollar yen, and obviously what's happening on FX with potential intervention risk. And then just look at some of the MACDs and the RSIs on TLT or the 30-year bond. So there are straws in the wind.
Yep. Huw, always great to talk with you, get your insights. A lot of great stuff, as always. Huw Roberts, he's head of analytics at Quant Insight.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
So let's talk to somebody who does this for a living. Margie Patel joins us, Senior Portfolio Manager at AllSpring Global Investments. Margie, you put all the cross currents together out there. We've got an update in the market today, but you put all the cross currents out there, whether it's the interest rate environment, whether it's a political situation in Washington. You put it all together. How constructive are you guys on markets right here?
Well, I think the market is going to have a strong finish to the end of the year after we get through this little seasonal weakness. I think people are just putting too much emphasis on interest rates as a determinant of economic growth, that if interest rates go up, the economy has to go into recession. And that has simply been wrong for the last year and 3 quarters. I think it will continue to be wrong. In an absolute sense, rates are still pretty low, especially compared to inflation. And companies are in good shape. So I think we're going to see a pretty decent growth in the third quarter reported and for the fourth quarter. So that's pretty good for stocks.
Why are you so optimistic, Margie, when we have, rate-sensitive companies that have led the charge? These tech companies typically should not benefit from a rising rate environment. And as I mentioned to Paul earlier, a lot of companies had expanding margins due to the inflation scenario. Now we're seeing that turn around, hopefully. And we're starting already to see companies come out with margin pressure due to disinflation.
Well, I think that companies have fundamentally changed how they operate in the last, say, 5-10 years or more, so that they have a much more flexible way of controlling their costs. So I think, again, you are not going to see the sort of margin pressure we saw in the past, that when inflation goes up, margins get squeezed, and they lose margins when rates go down, too. I think companies are going to maintain those margins. They've done that even with fluctuations in interest rates before. What's more important is, are their revenues growing, and can they control their costs so that they can maintain their profit margin? And I think they will. I think they'll continue to do what they've been doing. And keep in mind that companies are not over-levered as a whole. Companies restructured their balance sheets when interest rates were near zero. So they really aren't as sensitive to borrowing costs going up by short-term rates going up. In fact, it's benefited many companies because they have large amounts of cash balances on their books that they raise proactively. So they're actually benefiting a little bit from higher rates and those very low fixed costs that they used to borrow over the last decade.
So let's talk valuation here, Margie. I mean, there's a couple of ways to look at it. I guess if you just look at the headline PE multiple close to 20 here, maybe 19-ish. But if you back out some of those Magnificent Seven, it looks a little bit better, 15, 16 times. How do you guys think about valuation at this point?
Well, I think valuation is not an impediment to stocks going higher. I think the valuations are more or less within the average range. The average is, of course, pulled up because of a handful of growth stocks that have very, very high PEs, price earnings ratios. But for many, many stocks that have growth, their PE is really pretty competitive with their cash flow yield with short-term treasuries. So we think as long as earnings move ahead, we think companies can actually have higher stock prices. And who's to say we can't have an expansion in price earnings ratios if people feel a little bit more optimistic about economic growth?
How much of a competitive environment do rates offer here? I mean, when you see a 10-year at 4.9%, how does that compete with the S&P yield?
Well, I don't think it's a lot of competition because the S&P yield is now about 1.3, so that's not very high. But there are many stocks that have dividends above that and that are raising the dividends every year. And again, if you have capital appreciation as a company has rising revenues, I think that a 5% is really a pretty low hurdle for stocks to climb over and equal or do better.
How about on the fixed income side? We had a guest on earlier today, at a big bond shop on the West Coast saying, they're going out longer term duration. They are very bullish there. How do you think about kind of just in the fixed income space?
Well, I think that if you look at, say, the average bond, I think that corporate bonds offer more value than treasuries. In fact, if you look this year and last year, many people felt the best place to be was treasuries because they were safe. Yet actually investment grade bonds and high yield bonds, junk bonds, outperformed treasury bonds. They've continued to do that this year. So I think that to be long in duration and to be in the high yield space, a lower quality space, is going to continue to provide more return than treasuries.
All right, so on the equity side here, are there some sectors that you guys like, or are you more factors, whether it's, some of the factor investing that kind of...
You have like the Magnificent Seven. And by the way, I think it's a horrible name. So
it doesn't roll off.
The Big Seven, Margie, you've gone long those. So do you stick with that trade?
Well, I think so. As long as those names continue to have above average growth, they'll continue to be rewarded with a higher price earnings multiple, and I think investors will be rewarded. We've seen that when some of those companies have reported disappointing earnings, the stocks get hit. But I think really when you look at a world where we may have slow growth, there's still going to be a premium for growth stocks, and we may see some rotation, but we still like the technology sector as a whole, not just that handful of stocks, the communications sector, and even some of the industrials, which we think are benefiting from a capital expenditure cycle that probably is going to last a little bit longer than people think. So we think there's some good opportunities. The defensive areas, I think, are going to continue to be disappointing as they've been now for a year and a half.
Hey, Margie, we're going to have earnings season upon us sooner than we think in a week or so. What are you going to be kind of looking for here as we start to hear some of these companies report their earnings?
Well, number one is, are they still seeing good demand? I think that's really going to be the driver of stocks. And number two is really what's happened to companies' business with China, because we've seen some surprises so far where companies that have a big share of their business and growing business with China have been disappointed because demand there is really slowing down. So I think that'll be an interesting take to see what companies are hurt as Chinese growth slow down. But basically, I think we're looking for modest, moderate growth. And next year is an election year. It seems like we've been in one for 4 years anyway. And I think that'll be another decent year for the market.
All right, Margie, thanks so much for joining us. As always, Margie Patel, Senior Portfolio Manager at AllSpring Global Investments.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
our C-suite conversation of the day is we're talking decking, like the deck on the back of your house. And here's a data point from Bloomberg Intelligence. Drew Redding, he's the analyst that covers TREX. I guess there's 60 million decks in the United States, and maybe half of them need to be replaced. Mine is not one of them, I'm going to say right now. But we have the CEO of TREX right here with us today, so we want to get right to it. What do we got here? Bryan Fairbanks, he's the CEO of TREX. Now, this is a New York Stock Exchange listed company. TREX is the ticker. This is a $6.4 billion market cap company. The good news is stock's up 40% year to date. It is off about 20% off of its high of just a couple of months ago, but a lot of the market's pulled back. But Bryan, thanks so much for joining us here in our Bloomberg Interactive Broker studio. DEX. I got to think that's a good business. I got to think during the pandemic, people built a lot of decks. Talk to us about the state of your business right here.
Yeah, thanks for having us back on again. Absolutely. Through the pandemic, there was definitely a surge of people interested in outdoor living and wanting to expand their ability to spend time outdoors with their family. Even leading into the pandemic, we had seen that there was a significant opportunity to be able to really appeal to those families looking to add on a low-cost way to add on space to their homes. Within the repair and remodel index, approximately 30% of it is associated with outdoor living. And so we really sit in the sweet spot of that.
And what's unique about the decks you make is you don't use wood. What do you use?
Right. So we're very unique in that 95% of the material that goes into our deck boards is recycled and reclaimed. Last year alone, we recovered 600 million pounds of material that otherwise would have potentially gone into landfills. So this is in the form of polyethylene, plastic bags, stretch wrap, and wood dust. We combine those with a number of additives to make a deck board that will last basically for your lifetime. Our warranty runs anywhere from 25 years in our entry-level products up to 50 years on our premium products.
All right, so one of the issues that I'm sure you're feeling like a lot of businesses are is the consumer slowing down? Is inflation cutting into the consumer? So in your retail channel in particular, are you seeing any of that? Because we had Home Depots, we had Lowe's. They're seeing some softening trends in some of their big ticket discretionary items. Are you seeing that in your business?
The consumer has remained remarkably strong in 2023. Coming into the year, we did expect to see more weakness from that consumer. We originally expected to see flattish to down single-digit type numbers for the year. We saw that in the first quarter, and then through the second quarter we saw mid-single-digit increase. In our guidance for the third quarter, assumed roughly a low single-digit type increase in the consumer. So we've been happy with the resilience of that consumer. The other thing that plays well for TREX is our consumer tends to be at the higher end of the income spectrum. We're focused on those households over $90,000 average type income, so not quite as heavily impacted by some of these short-term changes in the economy.
So it's fascinating. I'm reading the research note from Drew Redding, who covers your stock, your company for Bloomberg Intelligence. He's at in there. The recyclable segment is only 24% of total sales in the industry. So you guys arguably, where do you think that number can go eventually?
Right, so composite decking of the overall industry is 25% of the volume sold. One of the strategies that we've been executing since 2019 is to really go after that buyer who otherwise would have been going to wood and take that, instead of being at 25%, take that up to 50%. When we started on this strategy in 2019, it was about 19% of the marketplace. So the strategy with those products to convert roughly 200 basis points a year has been quite effective, and we expect will continue to be. So does your company actually go to someone's home and build a deck, or do you just sell to the people who actually build the deck? We sell to the people who are building the deck.
Okay.
We will sell to Home Depot and Lowe's. We have our product on the shelf at both of those DIY centers. We also sell to what we call the pro channel. So these are locations that would be selling directly to the contractor, as well as homeowners and contractors.
So who do you compete with most directly? How does that work in your business?
It's a pretty concentrated industry. Our second competitor is about 25% of the industry, and then a competitor number 3, they are roughly 12 to 15%. So it is a concentrated industry, and everybody makes great products. It's able to service the market and really provide a much more superior experience for that consumer versus installing wood, which you'll have to maintain every year.
Yep.
And then as you started out with the piece, in a number of years, it'll have to be completely replaced again.
All right. So what's a typical, I don't know, what's a typical deck cost? What's a typical homeowner spend on a deck?
If we talk about a wood conversion type deck, that deck's generally 300 to 350 square feet and probably going to be in the $12,000 to $15,000 range. The material cost is not the biggest part of it. Wood, you'll spend about $1,000 for just the decking part of the wood, whereas our entry-level TREX deck's going up against wood's roughly $1,700. The biggest cost is going to be building that structure out and the labor that comes along with it. As I mentioned, our customer tends towards the higher end of the income spectrum. Those that are buying our TREX Transcend Lineage, and Signature products tend to be building much larger decks, and those average 500 to 600 square feet and can range $30,000 up to, we've got contractors building complete outdoor living rooms that include couches and TVs and kitchens, $300,000-$400,000 outdoor living areas.
All right, so I'm just looking at your income statement here. You got gross margins kind of in the high 30s, 40% kind of range. What are the levers really on the cost side for you guys?
Yeah, we've got a number of levers that we're pursuing. We have been pursuing and will continue to pursue. First is our capacity utilization. Every $100 million of additional sales that goes into our existing capacity is worth about 100 to 150 basis points of margin. We also have a strong continuous improvement program within the organization. We've got a group of people specifically dedicated not only to building the pipeline of what are those cost actions we're going after, but actually implementing and tracking that we're seeing the cost savings coming through. And then the last opportunity is going to be SG&A leverage. As we continue to grow as a company, that fixed portion of our SG&A can be leveraged.
Bryan, thanks so much for joining us. Really appreciate it. Bryan Fairbanks, he is the CEO of TREX, the composite deck builder out there. So for those that are thinking about putting on a deck or replacing a deck, you can think about the composites part of the business.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.